thought we'd wrap up the day today, which has been a long day where you've covered a lot of issues, with maybe crowdfunding's great. It's going to do great things. Entrepreneurs are going to raise money. Investors hopefully will make good investment decisions. But what are we concerned about in crowdfunding, and how, as an industry, have we been approaching those very legitimate concerns to make sure that the investor experience in crowdfunding is a positive one? And on the panel, you have very experienced professionals who approach this conversation in different ways. And it's a little bit of dumb luck, and I've changed the focus of the panel a little bit to suit my needs, because I'm interested in how we're going to present the industry with solutions to problems that exist in the exempt markets today. So I'm going to let everybody on the panel introduce themselves, talk a little bit about their business, and then we'll get into some of the issues that I was referring to. So Sanj, why don't you start?
Oh, great. Thanks so much, Doug, and appreciate you being here. And you know, it's a telltale sign you're a New Yorker. You're wearing a sweater in April. It's you know, and welcome to all our people from the East Coast. Thanks for making it out here. So I'm Sanj Goyle. I'm CEO of BancBox. Our flagship product is BancBox Invest, which is a payments and escrow service designed for crowdfunding and private placement. And you know, as Doug mentioned, our thought is to give you some sense of some of the pitfalls that you run into with doing these type of transactions, and that, you know, we each have kind of a solution set around that. And so BancBox, what we really look at is, and BancBox Invest is just one of our verticals. What our job is to make the crowdfunding platform, the issuers and investors, give them some comfort level around the payments, escrow, and compliance, which you've got a hard enough business creating a marketplace, curating deals, you know, bringing those together, that it's enough to kind of tackle that. Some of the basic plumbing around doing the payments, escrow, and compliance is stuff that there are companies that are focused on that, like ours, that can help you kind of, you know, hand that off so you can focus on other parts of your business. So what we do, first of all, is that we realize bringing people to a site, it's all about conversion. It's in friction, right? So if you've been advertised and you have a media spend, you want to be able to get that investor to make an investment decision on your site. So what we do is give you a set of APIs where you can collect money from the investor right on your site. So maintain that user experience. Number two, money as it comes in needs to be held, if you're a broker-dealer, under 15 C24. It has to be held in a third-party escrow and promptly get to a bank. And we have created that highway. So what we can do is quickly take a ACH debit transaction from the consumer, and through settlement with the Federal Reserve, the very next day it can arrive in a third-party escrow account at an FDIC-insured financial institution. So it's compliance with it's the conversion and ease of friction on your website. It's the 15C24 compliance. And then the third thing is that we provide is a system of record. So if you imagine that, you know, your businesses are really about trying to get to some kind of scale. And the idea of crowd investing is smaller deals in the few $100,000 might have a few hundred to 1,000 investors. The tracking of all that is complicated. And if I can admit, our company is now 8 years old. Back in the day, before we built a technology that created a sub-account ledgering system where we handled all the reconciliation and all that, we kept everything in a Wells Fargo account. And this is, I probably, you're my lawyer.
Wait, are we past the statute of limitations? Let's not go there.
We are. Well, what we did was, actually, we kept everything in one Wells Fargo account, and within 1 year, we had 6 figures amount of funds that we couldn't actually track. And it took us 18 months to go back and actually do it and allocate it. We said, we'll never do that again. So that's why we created this ledgering system that all of you can use through a set of APIs, which kind of takes that problem away. And so just as a company, you know, we're moving about $300 million a month, not just in, I wish that was all in crowdfunding, but it's in all across all of our businesses. We're maintaining this system of record for over $100 million of average daily balance. And so we're delighted to kind of be working now with about 40 to 50 crowdfunding platforms. And again, what we are trying to do here is just be very responsive to your needs and concerns. We've done a lot of analysis with Doug's help and others about what we perceive to be the problems and from a compliance perspective. We continue to want to get your feedback to enhance the product roadmap. So thanks very much, and open to answering questions after.
Jason, thanks. Thanks, Sanj.
Hi, I'm Jason Tripp, and I'm the Director of Risk Management at PENSCO Trust. We are a custodian for self-directed IRAs that custody alternative assets, in many respects similar to what we're all talking about here today. With private equity, offered it through a crowdfunding portal. Historically, we've been around for about 20 years, and the majority of our assets have been in real estate. You know, instead of someone buying stocks, they might buy an apartment complex and put that in their 401k. But over recent years, we've seen a really strong spike in people maybe being a little uncomfortable with the stock market, and so they're looking to put private equities in their 401k, so we're holding that as well. I would say we might have maybe $30 billion in real estate, another $20 billion in private equity, and we're seeing a lot of demand from our clients to try and find what's a good source of private equity, what should we invest in? So as risk manager, my job is to kind of look at the offerings out there and see what I feel safe to offer our investors. Since Christmas this year, we have integrated 3 different crowdfunding platforms into our systems. And what we did is we kind of looked at individual sectors of the economy, like healthcare, consumer spending, and we haven't done a real estate yet. We're still looking for one of those, but sovereign infrastructure projects. So we incorporate those into our platform, and then our clients can say, okay, I'm looking to invest in healthcare, and they'll go to this healthcare crowdfunding platform, and they're like, okay, we can make an investment. It's already been vetted, and then the appreciation they get on those assets, of course, is on a tax advantage basis. Similar with real estate, the rents in your apartment come in on a tax advantage basis. When you sell it, it's on a tax advantage basis. So I'm not spending my money, but I'm here with money to spend. We're looking to vet opportunities of crowdfunding portals and private equity and see what might be a good fit for our $50 billion of assets.
Oh. Got our attention.
Okay, we know who this rock star in the room is now. Okay, Michael.
Okay, I'm Mike.
I'm going to give a little backdrop to Michael, because Michael's important on this panel, important to me, because the first public offering I ever worked on as a securities lawyer 25 years ago, Michael was the banker, and it was his firm that did it. And so from an investor's point of view, Michael understands the sensitivities and concerns that investors have going into any sort of investment, having been a regulated professional for so long.
Okay, I'm here for 2 reasons, and this is my 3rd or 4th crowdfunding conference that I've attended and have spoken at. The first is that I'm a founder of a company which is in the financial information, produces financial information, and the financial information we produce is vitally needed for by the entire crowdfunding movement. That includes the issuers, the portals, and the crowd. But the second reason that I'm here is I'm also a visionary analyst. I have been in the capital markets since 1977 when I joined Merrill Lynch. And I believe that there is an enormous, in fact, I believe there's dynasty wealth is going to be created over the next 3 or 4 years by those who invest in those companies that supply the infrastructure to the crowdfunding movement. And I'm happy to have 2 companies, 2 guys on my panel that are infrastructure providers. Sanj I'm here to find guys like Sanj, because that's where the wealth is going to be made, the dynasty wealth over the next 36 months to 4 years. If you go back to, let's take the California gold rush of 1849. When that California gold rush, when they struck gold in Sacramento, it was enormous. In fact, the day before they struck gold, the U.S. bought California from Mexico. The day before, this was talking about inside information, right? Before they made the announcement, right? Well, what happened is the population of California grew by 20 times in 11 years. Made it 11 years later. It had such a population, it became a state. And the key is that 15% of the U.S. population moved to California, okay, to pan for gold. But who is it that made all the money? It wasn't the gold miners. It was Levi Strauss, who was the guy who was there with the jeans, because they all had to live in these conditions. So Levi Strauss, the company, was born. It was the tent manufacturers, and it was the shovel and the pick manufacturers who all made the fortunes. It wasn't the guys who were panning for gold. So I'm here to say today that I've done extensive research on those pre-IPO, on what's going to happen in this the next 3 or 4 years, and there's going to be significant amounts of money that are going to be made, and I'm prepared for it. And I'm here to identify those companies, and I've already identified over 20 pre-IPO candidates. Now, why is that important? The biggest gold rush since the gold rush the biggest gold rush in the history of this country started in 1995. In the history of this country started in 1995, when Netscape commercialized and made the browser available for free. Okay, at that time the internet had been around for 20 years. There had been 16 million people on it. AOL did its IPO in 1992, and the IPO was still well below its 1992 IPO price when Netscape commercialized that browser. Well, what happened next is the web population took off and grew from 16 million in January 1st, 1996 to 360 million by 2000. And Yahoo launched its IPO without filed its IPO, raised several $100 million, had a market cap of $1 billion. It didn't even have a stitch of revenue when they filed their IPO, never generated a dollar. So what happened was AOL stock was below its IPO price on January 1st, 1996. The stock went up 3,200 times in 36 months, means 10 grand was worth $32 million, okay? The same story happened for all those web companies. Enormous wealth was created over a relatively short period of time. And everything that I've done, my research, which is available on my special research on onlinefinancialsector.com, there's a video about this. It's staggering what's going to happen. And it's guys like Sanj here who if he's going to get out here and he's just told you what he's doing in the marketplace, you want to figure out how to put your money in the private pre-IPOs of guys like Sanj is what you want to do. And that's what I'm here to talk about today, those two things.
Great, Michael. Thank you for that perspective. And what I think another way of saying what Michael, or putting what Michael is saying is, we need, in order for this industry to work so the picks and shovels become valuable, is that the portals have to be well constructed, both from a regulatory point of view and from a commercial point of view. What Sanj is doing is required by law in Title III. The SEC's opening remarks to us when we went to visit them April 20th, 2012 was, who's holding the money? The public doesn't want the portal operator holding the money. He is going to be doing it in association with commercial banks, and that's how you comply with 15c24. Interestingly, Title II platforms, which are not going to be necessarily regulated by the SEC and or FINRA, they don't have the 15c24 requirement, but by convention, effectively, they do, and they're doing it in any case because investors don't want to just hand over their money more often than not to people who aren't doing it. And Sanj, if you would speak for a second about what you're seeing with the funding portals that are doing business today that are Title II, not Title III, is that in fact what's going on?
Yeah, absolutely. I mean, I think that, we've seen, when we talked, and by the way, thanks for all the, I wish I could take you to my board meeting.
Actually, I think it was a general solicitation for you.
It was, I'm just not used to those kind of kind words, actually. But what we've seen is, when I go to my board meetings, our VCs say, well, you're a startup, and then you're participating in a startup market, right? So that quadruples the risk. And so what we've seen, and we take that on, but we kind of looked at it like you did, in saying that you really have to have some belief that a market is going to be made. right? And the outsized returns, and we as a venture-backed company, to get a venture-type return, you have to make some of those judgments. And fortunately for us, we built an infrastructure where it's kind of our invest product is an extension of it. So we're in a sense diversified. But what we've seen is just a fantastic growth over this last quarter. I don't have the exact details, but we've seen probably 1,000% growth in the number of deals. We're now probably crossing 8 figures a month of deals that we're doing. And this is just the close of Q1 2014. We don't have Title III yet. That who knows when that's coming. But there's such a good interest right now amongst the investment community, the crowd in these deals, and that I think I actually invested in 5 deals last year, and I got my first exit. So the good feelings start to happen. It was a small deal, but I don't know if you guys have seen this, but Lovely, the apartment listing company, was bought by RentMap. Kind of a small cap deal, but still, it was the first time. It did a lot better than my 401k, and it did a lot better certainly than the money that sits in my checking account. And so what I see, Doug, is that the question will be how do those investments do vis-a-vis Lending Club? How do they do, right? So we are a segment of the alternative investment opportunity. And I think, good stories like that, as they start coming out, are going to make,
Right.
kind of see that hockey
Well,
stick.
by the way, I think, Sanj, you have an unbelievable, I didn't even know you're venture-backed. I mean, that's really, really impressive because according to my projections, and I think these are conservative when I put these projections together, there's going to be 50,000 global portals. So you got 40 customers right now, okay? So you're basically servicing, you're in the business, you've got the experience. This market's going to explode because I've got my own comments on Title III, which is a whole nother panel we should have why I think it's going to explode. But the situation is you're right. Your board needs to understand you got 50,000 potential customers out there. And when they understand that and the bankers start understanding that, that's where you're going to get the big lift and you're going to get the big IPO. That's what's going to happen.
And while I want to be enthusiastic in that manner, and I'm glad Sanj is making money on investments as well as his own business opportunity, Jason's business is to analyze which crowdfunding portals are appropriate for his investor community. And so he looks at various risk elements of those portals, and I'd love you to go through a list of some of the primary issues you look at to decide which ones you're comfortable with.
By the way, Chuck, let's mention this. Definitely, I want to say that he's also in the position to be a game changer. His business. I don't know what their structures and what they're doing, but clearly, alternative investments at PENSCO, also in the same position. But I know it's a big company and all that, so I'm not sure what it's doing.
Sure.
But go ahead. I don't want to slight you because you guys are both in the. You're in the game you're going to win.
You're doing okay,
is, can you
Michael.
do with IPO? What?
You're doing okay as well.
Okay.
Yeah, well, when I do due diligence, I think back to the days when I used to work at FINRA and conduct due diligence of private offerings, Reg D offerings. Investment firms like Wells Fargo, E-Trade, I used to audit their books and records. And if I guess I had to spill a secret sauce, it would be the cost of capital. I mean, everyone does background checks, everyone does audited financial statements, everyone does the standard, things you'd expect from your CPA. But cost of capital is my favorite one. Whenever I see an investment come in and someone's paying 11% for capital and they're offering to pay someone 16%, my thoughts are, well, what kind of crappy business do you have if you have to pay 11% for capital? Interest rates are very low. If you pay a high price for capital, you probably have a risky business model, which is fine as long as you accurately present it as such. But my secret sauce for auditing is probably cost of capital. I think more often than not, that's helped me weed out bad actors and protect our clients and the firm as well.
And Jason, just let me drill down on that. That's an issuer that's posting to that site? Is that a poor reflection on the CFP or the issuer that's posting to the CFP?
Well, it's I kind of look at it from the business model itself. However it hits my desk, I just kind of try and back out the math. So I try and examine the business model itself, and if it makes sense, then I'm inclined to let it in the door. But if something just doesn't smell right, then I have to reject it.
But I just want to drill down a little bit more on the 3 CFPs that you agreed to do business with.
Oh, sure. Yeah.
One of the things was, are they a licensed professional?
Yes, I'm a big fan of, I like regulators. A lot of people kind of like, this might not be the best audience to say that, but I like dealing with regulated entities because they have skin in the game. The bottom line, if you have a crowdfunding portal, someone in your organization who has a Series 25 license has pressed a button with FINRA to where they accept direct personal liability. And I love that word, direct personal liability, because that's someone else getting in trouble, not me. It takes a little fortitude to press that box. So yeah, I like other people having skin in the game. That makes me sleep a little better at night.
Hey, Jason, can I ask a question? When you say cost of capital, is that you're saying if an issuer is on a site willing to pay out in the high teens, that's a flag for you that they're too desperate or it's a shaky business model?
Yeah, I look at the spread between what they're paying for capital, maybe it's coming from a bank, maybe it's coming from private investors, and then what they're going to pay out. I do that and I say, okay, well, why couldn't you just go to a lending club and get the money for 6% or 8%, for example?
Okay, what other tools, Michael, have you seen in your analysis that may appear in the crowdfunding ecosystem that maybe is not represented on the panel that you think from your days in the brokerage business is critical and necessary? I know there are valuation tools that are on the horizon. What other picks and shovels
Well, I
do you
think
see?
the key is, and somebody said this earlier today, they're a bright young guy, I can't remember where he is, or he was up here as a moderator, and he said there's 2 things that you either need to understand the industry or the people, okay, to make an investment. And the industry or the people. You know, you got to either have really impressive management or you got to really understand something about the industry. So the key is what the software that we develop for my company happens to provide industry data on all industries. So, and this is the key to the whole crowdfunding movement, is you've got to be able to have industry comparisons. So that, right, for instance, we track 220 industries in my company. So the key is if you don't know how fast the industry that the company's in is growing, how are you going to distinguish which company you want to put your money in? Now, I will tell you, medical software is currently the fastest growing industry in the United States. So if somebody comes and he's got a medical software company, he's looking for crowdfunding, you find out, oh, this is the fastest growing industry in the US, it's a no-brainer. But that's really the key. I think you got to have the industry data because you don't have any comparison. It's like real estate. What if you didn't have the MLS listings? You know,
But let's talk about that, because I think maybe we have the advantage of, since we're in the industry and regulators and maybe some people in the room don't have, is there are people who are addressing that issue technologically. So as an example, Crowdnetics, Luan Cox's business, who's not here, she has taken the API feeds off the existing Title II platforms, and in real time now on CBS Market Watch, you can see, like a public company, which companies, which industries
Absolutely.
are raising what money, price to book, price to revenue, price to prospective business model. And so that you don't typically, or historically, wouldn't have seen as
No, I
an
would agree with
investment.
you, and Crowdnetic would absolutely is doing a great job there on CBS Market Watch. I know Dara's with them, and I know Lauren, and all. They're very.
Well, let's throw
yes.
out names and see which names are on your list of pre-IPOs.
Well, actually, there was another one. I have about 20 companies in the video that is on the website. It's onlinefinancialsector.com. There's 20 pre-IPO companies. Lending Club is one of them. Prosper is one of them. They're both on there. And
Lending Club's obviously in registration as we
Lending
speak.
is already in registration. I've been saying it's going to go, for public for a while. And there's Cabbage is one that's interesting on the information side.
How about LegalZoom?
Yeah.
Why is that?
LegalZoom? LegalZoom, yes.
LegalZoom is a standardized legal documents
Right,
business.
right. Yeah.
You
That
know,
would-
actually, just to kind of back.
No, he just didn't want. Most people think that offends me somehow because it's legal in nature. Sanj, you wanted to say something?
Well, actually, just to back up what Michael and actually Jason were both saying, it's about you kind of have to know the investment. So actually, our lead director from Foundation Capital is on the board at Lending Club. So he led the C and D round. And so, and we talked to them a lot. I mean, it's interesting that Prosper was, kind of in this class of alternative investments would hit the market first, right? But Lending Club is 5 to 8 times bigger now, right? And the question is, like, how did that happen, right? Because they both have the same regulatory schema they had to comply with, but just, one had an outsized success. And if you go back and, what Charles was relaying to us is, it's that Prosper had a notion of a marketplace where the buyers and sellers would do their own work, and the reality is they just can't. So the idea of doing the homework, doing the underwriting, coming back and taking someone's credit score data and saying that's an A1, 2, 3, 4, 5, all the way down to G, made it something that individual as well as institutional investors could make decisions on. And so that's one of the things that if you look that the ability to kind of look into a crowdfunding platform, an issuer, and give it some type of scoring is just really critical to the success of these markets.
Yeah.
Well, Zacks just came out with their crowdfunding credit online capability, and there are several other people that are. Kim Wales has a site that she's going to be coming out with that does credit analysis. So there are all these different service
Yeah, there's another one,
providers.
CrowdCheck. Sally,
Well,
is this not,
that's
no,
Sarah.
not Sally, I'm trying to think.
Sarah.
Sarah. CrowdCheck is another one, that
Due
is
diligence.
needed.
The question is S&P ratings doing anything in this realm? Because you would think they'd be a natural suspect.
Zacks is doing something equivalent to that, and there are other people who are doing things in and around that. So you're going to see that. But there are other there's a site that is down in Southern California that's doing background check analysis, and along with that, they're culling a lot of other personal information to come up with a metric to help you decide whether or not that individual or that company's profile is predisposed to be fraudulent activity. So people are doing things very differently, to Michael's point, and they're approaching this world based on the experiences of the offline world, but they're doing it with new tools, and it's very interesting.
Yeah, and the thing is it's, this is a whole movement. This is the projections I have on this thing are massive. This is moving. There's 20 public companies out there. Stocks are on fire. They've been on fire since last July. Big cap companies that are moving in anticipation of this thing. This is going to crowdfunding is going to revolutionize everything. So you got to think about, who is going to become the S&P of this industry? This private capital markets is going to dwarf the public markets. You watch what's going to happen. And those companies that emerged and start doing this, S&P's not going to be the one that does it. It'll be some small company. You got to find it, and that's why you got to come to these conferences to find them. I wouldn't have found you unless I came to the conference. I'm here to find companies at these conferences and also talk about my own company and what I'm doing and all that other stuff, obviously. But that's what you got to look for when you come to these conferences.
But Jason, other than the picks and shovels, because embedded in the assumption that Michael's saying about where he's going to get you all frothy and all ready to invest and then ask you to invest in Sanj's company, not that it's no open round,
Right.
is that there are good opportunities to invest in these emerging portals. If we don't have good investment opportunities, none of this matters. And so, Jason, when you've looked at this industry and you're willing to see your firm commit capital, is it true what a lot of the Valley folks have said over the last couple of years, that only it's self-selecting, only bad deals are going to go through crowdfunding platforms?
I've seen a lot of success, and it certainly is not through any the fact that I'm smarter than the average bear. First, I see the success through investors. I run various reports, and I see who's doing well, and I kind of drill down, and I look at their investments. And I worked with Renaud Laplanche when Lending Club was first getting started, maybe 7 years ago, and I worked with them for a while, and then I thought, this isn't a very good idea. I need to go back to some regulatory job like at FINRA, and like an idiot, that's what I did. So I wish I had known then, of course, what I know now.
Would you tell me that line one more time? You went back to FINRA?
It was, I hate to admit my own stupidity, but no, I just wasn't bright enough to put the pieces together. But Renaud, that's why he's Renaud Laplanche, and he's so successful, because he saw things that other people didn't. Certainly I wasn't smart enough to see.
Well, if I could on this one, this is interesting. So I think most people are familiar with AngelList as you know as a platform, and so if you look at the numbers, how many? Let's just kind of put this out there. How many deals do you think AngelList has listed in its history, in its 3-year history? Like throw out a number.
10,000.
10,000. Anyone? 30,000. Anyone? 5? Okay, one last guess. Everyone's too low. So the answer is 85,000. Okay? So they've listed 85,000 deals, and how many do you think got funded?
Well,
Interesting.
since
On this one, everyone's too high.
Since September 23rd or before.
History. I don't know the numbers from.
Okay, since September 23rd is less than 50.
No, it might be the new ones. It got to be more than that.
Okay,
Since September 23rd, the
Could be.
generally solicited deals is I think is less than 50.
Well, they've done about 1,200 in 3 years, right? And there's a big ramp, right? So they've done a lot more this year than the last couple of years combined. But if you look at it, so and that's something, and that's a crowdfunding platform that's raised $25-30 million, comes from some pedigree and all that, and gets a lot of press. And what people say even on that platform is it's not that. So there's a lot of deals that don't get funded. So first of all, right? So and that's number one. But what they say is that the issuer has to know how to work the crowdfunding platform. Like just listing on the site, if it's because they don't do a lot of curation. That's not their model. So just an issuer knowing what the crowdfunding platform is going to do, is a listing service or is curation. And then if it's listing, what you really have to do is there's kind of a methodology of how you work AngelList, right? You've got to go get an angel first, and that angel links. And then when you go on that site and you see this company, like, oh, okay, an angel invested in it. So there's all this predicate work that you do before you want to list there if you're going to at all be successful. So I think that just knowing, it's like, okay, what field are you plowing from? And I think that, the smarter raises, I think, recognize that and it'll only continue. So, like if you look at on the real estate side, okay, there's ones that curate and are really good at a restaurant deal, right? So that'll be the right place for if you're a restaurateur.
Right. I want to open up for questions, but let me reverse that. I think the answer on AngelList is without a lead syndicate manager, they haven't raised any money for any company since September 23rd. So you need somebody who's willing to validate, structure, monitor the investment. Questions? Ma'am, you go last, Mark.
I've worked in the traditional asset management space for a while, and when you hang around that space for a while, you long understand there's different investor types, personas, if you will, and self-directed investors seem, at least in this initial phase, to be who's coming to crowdfunding. And what you're saying, Jason, to me is very interesting and in par or in keeping with a lot of investors who I wouldn't necessarily call self-directed, but rather people who are interested in diversification but don't have the time, the energy. They're running their own businesses, right? And also want that additional layer of, let's just say, in their mind, sensibility, recommendation, or personal
Yeah.
touch. And what you're describing, what you're doing, sounds to me like perhaps the tip of the iceberg to a whole nother level of servicing, right, to the accredited investors. So I guess I'm really making more of an observation and these thoughts are running through my head that perhaps needs to play a bigger role in what's going on as well to get the next level of interest beyond the 35
I'm gonna give you one observation. If you go on Angel List, they have a thing where with a click of a button, you can participate in a pool of assets that have been pre-assembled by a venture firm or whatever, and so you have the diversification. They've done all the work. But did you want to add something?
You're gonna have to take it further, because these are folks who want a place like right in front of them, you know.
Wow, you know, Pam, you're pretty good at this when we're hiring at PENSCO, so maybe you can email me your
I know
resume.
By the way, I used to work with that.
Oh, that's right, Eileen. Well, there you go. Okay, good. You know, that's a good analogy. One of my, I think a really good parallel that I was just working on yesterday is a local gentleman owns a large sausage company. He produces all sorts of sausages, but his investments with PENSCO are in trailer parks. Now, it's just by chance that they're in trailer parks. His daughter, I think she needed a job. She wound up getting a job. And trailer parks, it turns out, are a fabulous investment.
Unbelievable.
I analyze hundreds of investments all the time. I do it literally 5 days a week. And I don't think I can think of anything that's probably as good as a trailer park. I wish I had been smart enough to invest in them younger. But that's just by chance. But he's also very interested in private equity, as we've introduced him to, you know, our healthcare portal that we're integrated with. He made an investment. He's like, okay, that kind of makes sense. You know, sausage is something I understand. It makes sense. Trailer park makes sense. You know, he's 84 years old, so going to the doctor, that makes sense. Yeah.
Okay, Mark, you had a question?
My last?
No.
Okay. So, I know this is a Title II panel, and you mentioned curation. What's the role of curation for Title III?
Well, I'll tell you, I think the SEC is going to back off their position in the proposed rules. I think they're going to allow full curation.
They're going to allow full what?
Curation, that the platforms can pick and choose which deals get posted to their site, as opposed to that being deemed to be investment advice. And their Title III prohibits crowdfunding platforms from giving it investment advice.
Yeah, the other thing, by the way, I mentioned this. I know of a company that I'm tracking right now that's really fascinating. What they've done is they've developed the software, and it's a crowdfunding portal right now in Europe, but they've developed the software for that they send you, an entrepreneur goes to them and says, we want to list on your site. And they send them a questionnaire. When they get the questionnaire back, it prompts them to send them a second questionnaire that's based upon the answers on the first questionnaire. So you're going to get a different questionnaire if you give different answers. They figured it out. What they figured out with these, after 3 questionnaires, they can figure out how serious the entrepreneur is about holding on to the deal through hell and high water. Because deals succeed only because someone's there and to keep the light on no matter how much stress is underway. So they've been able to figure that out. And their track record, they've been out doing this for 4 or 5 years now, is super in terms of their track records of success. So that's the software like that's coming, and that we're going to see. And I believe somebody else talked about that. Chris Terrell, I think, this morning talked about something like they were doing things like that on their portal. So very important thing.
Brian, you had a question?
To use the analogy of picks and shovels, buying them and getting involved in service providers, I think it's pretty exciting. I agree with that. Want to get your comments on what's after you invested and want to unload the investment for liquidity or otherwise. I just thought if you guys can kind of finish up with what's happening. I know in Canada the TSX announced a whole initiative with private capital markets, providing secondary liquidity in the private capital markets. Everyone's trying to understand that and figure what is happening there, because there's no resale rules in Canada and in the exempt market. So they're trying to provide liquidity for creditors. Can you comment on the liquidity aspect after someone makes an initial investment here?
This infomercial has been brought to you by Castles Brock. By Canada. Okay, great. Michael, that's probably a good one for you to field.
I think that what's happened, where the market's going to move to, is the private capital markets are out there. You know, Facebook traded on the second market for 3 years before it did its IPO. So I think where it's going to move in that direction eventually. Doug knows more about this than I do. But I think that eventually what's going to happen is, yeah, you're going to wind up with some liquidity, maybe just from accredited investors who want to scoop up the shares on the private market. I don't know that it's going to happen with, with unaccredited or not. Maybe you want to come in on that.
I mean, the observation I'll make to you, Brian, and Brian and I talk about this all the time, so it's kind of like we're sitting around having a beer talking about it, but I think we don't know, actually. I think there are certain rules that I can sit around with you and other Brian Corners in the room as securities lawyers, and we can postulate what we think the right current way of doing things. I think what's really going to happen is a year, 2 years from now, when there are all these deals that are kind of trapped, rules are going to change because establishment doesn't like them anymore, and they're going to force blue sky laws to change and secondary market rules to change, and all of a sudden there's going to be a place, whether it's on the OTCQX, which we talked about this morning, or the CalX, which Howard Linhart is involved with, and all of a sudden we're going to find, and the publicification of these exempt securities with disclosure being out there on Cedar or Edgar or whatever, is going to mean that public and private are really merging. And there are going to be new ways, I think, for some of those companies to find their way to have public liquidity. Whereas I think the vast majority of them either will go out of business, get sold privately, and it's the rarefied few that will make it to the public markets, is my view on that.
Yeah,
Jason,
I totally agree with you.
Jason, do you have a view on that?
Yeah, I'm glad my boss is not here. When I came to join PENSCO about a year ago, we actually had a list of service providers that offer that type of service you're describing. And I looked into them, and they were all terrible. There's really not a good provider of that. And I think it's a huge unmet demand. If anyone knows of one, let me know, because I'm looking for one myself.
Sanj is funding a new business to create secondary market trading. Would you like to fund him? Did you have follow up?
Sorry, I wanted to go back. We were talking about
Rating agencies.
the S&P, which is very interesting to me. And I guess my question is, would they be rating, do you see them rating the actual curators, if you will, of a crowdfunding platform, just like almost like a fund manager team? Or I heard this discussion of rating individual companies, which seems, if you have a curator, why would you?
You're going to have both. I mean, I
Yeah,
think most of
absolutely.
the agencies are talking about the underlying securities of the people who are posting to those sites. But why wouldn't you also, which is really what I think Jason's doing, is analyzing the success or failure. If you're a portal that's known for curation, everybody's losing money, I think people want to know about that.
Seems to me that you would want to have both.
Both. Yeah. Any other question? Sanj, did you want to follow? Well, hold 1 second. Sanj, did you want to?
Actually, okay, not necessarily follow up, but one thing we were talking about, kind of some of the impediments to crowdfunding really taking off. One of the things, I have a friend of mine who's a VC, a successful VC. His wife owns a yogurt shop that was Steve Jobs' favorite yogurt shop, right? So, successful retail business. I mean, I don't ask him in financials, but so someone who's well networked, successful, but they need to do a raise of money to open up a next store, right? And it costs a few $100,000, and it's really easy, knows a lot of high net worth people that could put up the money, but the facility of going to a website and being able to list information and being able to do a crowdfunded raise, even when you've got kind of established, you've got families and friends who would want to do that deal. Now I know there's companies like Local Stake and DealStruct that kind of focus on that. The one thing I was going to ask kind of the crowd here, I guess was interested is that small businesses that want to raise money from a community, it's the rules are going to require them to list their financial information, right? So I'm curious what the group thinks about how that's going to get protected, so your sensitive, your confidential information that you don't want competitors to see is going to allow you to kind of list and get, make it public, make it accessible so that people can make an investment decision, but protect you from competition. And that's something where I've often thought, like, that is one of the biggest, it's actually caused me a lot of pause. I was like, right? I mean, because there are, I mean, when you say trailer parks, I think the next great business is car washes. I mean, they just make a ton of dough. Now, they may not be venture financeable, but they're great for this type of crowd. I mean, they'll give you a return.
So are trailer parks.
Yeah, well, I'm saying, like, wood trailer park, right? I'm just
Yeah.
saying, but those are the kind of things where, okay, if, you know, it's competitive, and if you have to list all of your financial information, right, is it gonna be a real impediment to using these portals? And and you might have to go, you know, the kind of the old route, the paper and pen route, if, to protect it.
Right, no, I would love for somebody in the audience to answer that, since now apparently the panelists are asking the questions of the crowd. So, and who here wants to answer that?
Well, I have a partial answer, and that is that a lot of the income verification for accredited investors are already being automated by crowdfunding services. So that is one way to get around it. We can go directly to the IRS and get tax returns for those businesses.
Okay, so that's a partial answer, and the answer is under the rules you have to make your financial information available, and that's just the cost of doing a Title III campaign, and then on an annual basis as well. I think that you will be able to provide ongoing information, probably through a password-protected way or a virtual data room of some kind for some of the more sensitive information. And since Brian's shaking his head, then I know that I nailed that answer. Excellent. But you're going to have to, it's going to make some people uncomfortable, but that's again, as a securities lawyer, I'm okay with that. That's, you got to do that if you want to get the public's money. Oh boy, I just feel a few more.
Thanks, Dr. Jason. We're a client of yours.
I know. Thank you.
Conflict has
Thank
been disclosed. That's great.
So the question is, how do you, or do you, firewall your custodial duties against your, I don't know, if you make recommendations as to where your client should invest through the crowdfunding portals that you're doing?
Well, first of all, as a point of clarification, just in case any auditors from the state of New Hampshire are in the room, we have never made a recommendation to anyone. Never, and we never will. What we do is we perform an, quote, administrative review on assets, which hits my desk, and then after that it's put on the platform. So the sausage guy can see, okay, this has been administratively reviewed, I'll look it out, other customers are happy, they haven't made a complaint. And that's kind of how the process works. We're regulated by the state of New Hampshire, who does a very good job, I might add. And yeah, no recommendations.
Okay, all sensitive questions like that have to be taken offline. We don't want anybody getting into trouble. And so Brian, no zingers.
Do you think that the curation issues could be bypassed by, instead of having funding portals, actual broker-dealers?
No, that's not, I mean, that is a way that, under the current proposed rules, you could do that. The other way, as Michael was referring to with the question, you can have people opt in. So the Amazon model, where I look at a biotech deal, I do a biotech deal, the crowdfunding portal under the proposed rules wouldn't be allowed to show you the next deal that's like that unless you said affirmatively you wanted to. The SEC understands that they've got a bad formula. Full funding, full liability for crowdfunding portals, but you can't choose which deals go onto that site. That's untenable. They recognize that. They will tell you, and they have, that the way they wrote the proposed rules, curation isn't written the way that we're all reading it, which is that you can't do it. They believe that their catch-all is, it's anti-fraud, you're allowed to curate liberally. And we've said that's nice. All that's suggesting is that you have interagency disagreement as to how to write that. So I think in the final rules, you'll see that that gets very liberalized. So crowdfunding platforms, Title III crowdfunding, non-broker dealers will be able to curate, in my estimation, if that's the answer.
Your interpretation of curation, that a portal can't turn a deal away?
Yes, that is what we're talking about in this context. It's pre-posting to the site, which I would argue still isn't giving investment at all, because all you're doing is picking and choosing before the community gets to see anything. But that argument was unsuccessfully advanced.
So what was the answer on this? You can't turn it until it inside?
Trish, you're not going to be invited back to my class if I have to repeat myself. So crowdfunding portals, Title III, will be able to choose, I believe, which deals go on their site, is the short end. That's not the way the proposed rule reads today. Any more questions? Any more comments? Any more questions from the panelists to the audience?
I see the guy here got a beer. Where's the beers at?
I think we're up to that point. Sydney, so I think, Sydney, that concludes day one. Thank you very much. Thank you, panel. Thank you, audience.